Tech stocks are pumping, earnings are strong, and retail investors are still buying the dip like it's second nature. But if you're only watching the green candles, you're missing the real story. From government data under fire to historical shifts in trade policy and cracks in the Treasury market, let's break it all down, everybody. So, markets ended the day in the green with tech leading the charge. Maybe on the news we got from Apple that we'll be getting as far as their investment into the US and their plans regarding that, investing another $100 billion. And this was reported from White House officials. The NASDAQ 100 rose around 1.3% on the day. The S&P 500 gained about 0.75%, and the Dow ticked up about 2.2%. And it's clear that retail investors are still laser focused on tech and AI, aggressively buying into every single dip that we get. And this pattern becomes nearly predictable at this point. But instead of chasing the current leaders, what if sitting out turns to be the smarter move right now? Now let's talk about it. So skipping out on the high-flying names like Nvidia and the rest of the Magnificent Seven, that could be the contrarian move that actually pays off. Historically, when the market becomes overly concentrated in just a few names, which we're seeing right now, it tends to correct itself. And currently, the top 10 stocks make up nearly 38% of the S&P 500, and the Magnificent Seven alone accounts for about a third of the entire index. And that imbalance could be dangerous. A passive S&P 500 investor could be dragged down if the leaders underperform. And they talk about this in this article right here. You could go check it out for yourself. But they say, consider this. A $10,000 investment at the peak of the dot-com bubble back in March of 2000 would have shrunk to $8,200. And that's why diversifying in these unloved names like small caps and mid-cap value stocks, or even funds that screen out the biggest names, could be a better long-term play if market sentiment shifts. Not guaranteed investment advice though. Who knows? This AI train could keep on going. But while AI has a promise, assuming it's immune to historical trends is a risky bet. FOMO, fear of missing out, often becomes regret when the tide begins to turn. And retail traders, they've really been powering the show right now, playing a powerful role in today's market. According to Nationwide's chief market strategist, Mark Hackett, the unusual historic patterns have flipped on their head as institutions, usually the dominant force, and who knows how long the trend continues this direction. But right now, institutions are now reacting to retail's aggressive buy the dip behavior, which isn't necessarily what history shows is the case. Hackett points out that institutions face this dilemma right now with tech stocks are so heavily weighted that it's hard to stay diversified, and without being overly exposed, it's hard to really make sense to their shareholders of why we're so concentrated in these puffed up names. And many funds were conservatively positioned earlier in this year, and now they're being forced to chase this rally because they were just missing out on so many gains sitting on the side. Something Hackett calls a terrifying place to be right now. And he expects the market to remain pretty choppy through September, just like everybody else does, before gaining traction from fiscal tailwinds. But for retail investors, this may not be the best time to pile on to more risk with valuations sitting where they're currently at, cautioning that high valuations and economic signals are mixed right now. Now let's talk about this battle between corporate earnings and government data. So interestingly, weak government data is having less impact on markets right now, and that's because corporate earnings continue to impress, often beating expectations. And as long as companies are growing, weak macro data is being more viewed as bullish. Recent jobs data revised downward significantly, around like 258,000 fewer jobs than initially reported back in May and June, and we've talked about this here on the channel and other videos. It really, instead of triggering this panic in markets, it rekindled hopes for interest rate cuts. So everybody's seen the bad data and they're like, woo, bad news is good news. We're getting rate cuts, baby. Stocks to the moon. And add in the fact that investors prioritize profits above all else, and you get the market that remains resilient even in the face of unsettling news. The S&P 500 closed to all-time highs. The VIX, which is the Wall Street's fear index, fear gauge is hovering around its long-term average of 19, and that suggests investors aren't necessarily panicked. And some believe the current administration is actively using every tool available to maintain economic momentum heading into the election cycle. But there's this data integrity question. So the integrity of government data is becoming a hot button issue right now after the massive revisions to the jobs report. President Trump fired the Bureau of Labor Statistics, the BLS's top economic statistician, accusing them of manipulating the numbers for political reasons. This move, combined with budget cuts at the BLS, the Bureau of Labor Statistics, has led concerns about the quality of economic data, particularly among the Consumer Price Index, the CPI, which is critical for setting interest rates. It plays into calculating Social Security adjustments and guiding financial markets, and also plays into the Fed's preferred gauge of inflation, which is PCE. So if this data loses credibility, markets could become more volatile just because we're walking in the blind. And especially vulnerable is the TIPS market, the Treasury inflation protected securities, which adjusts based on CPI readings. So if investors suspect that CPI is politically influenced, the ripple effects could be enormous because we don't know, like right now we got data based on the history. But if that historical data that we got's not necessarily accurate or relevant, throw all of that out of the window and we're just walking in the dark, which, I mean, the past doesn't repeat itself, but it tends to rhyme. And without the data, how do we make a poem out of it? I just made that up on the top. So the Federal Reserve might keep rates low for too long, only to correct later by overcorrecting. And this could steepen the yield curve and cause uncertainty across global bond markets. And there's this response to rates and economic blind spots right now, which are complicating things further, which is the declining accuracy of those government response rates for key economic indicators, which have dropped from over 80% a decade ago to under 60%. Wait, I think we're still on this one right here. Which means more revisions, more guesswork, and more uncertainty, which we were just talking about. And uncertain is not good for markets in the economy. So tracking economic shifts like immigration patterns or small business closures has become much harder in the current day. Without clear data, households, businesses, and policymakers are just flying blind, and that leads to mistakes. U.S. GDP growth slowed to 1.2% in the first half of 2025, which is down from 2.8% back in 2024. And that deceleration coincided with trade uncertainty and a pullback in consumer and business spending, which not looking good. Now let's talk about this global tariff war. So we're caught back up. Tariffs on semiconductors are coming within about the next week or so, according to Trump. We'll get more data on this next week, but it seems unlikely a market correction or market conscious White House would deal such a blow to the technology sector, which has been driving this stock rally. Lost my words right there, but pretty much what I'm saying is tech stocks and AI AI spin has been what's powering this stock market to new high, on top of this still high interest rates, tariffs and tariff uncertainty, and the seems to be higher than expected tariffs we've got, all in the face of a stock market going higher and higher, and that's powered by stocks like Nvidia, AMD, Taiwan Semiconductors, all of these chip-related plays. So tariffs on these semiconductors, depending on where they go, could deal a large blow on the stock market entirely, because a lifting tide lifts all ships. Now, today, Trump said that his special envoy, Steve Witkoff, made great progress in a meeting with Russian President Vladimir Putin, though he acknowledged the conflict would likely continue beyond his self-imposed deadline that he gave for a ceasefire with Ukraine. Trump called the discussion highly productive, adding, everyone agrees that this war must come to an end. So there's a final consensus there that everybody agrees. It's just, how do we get there? And he wants to work towards that in the next day and weeks to come. So a White House official said that the U.S. will still likely implement crippling new secondary sanctions on countries purchasing Russian energy by the deadline coming up. Russia, the official said, still wants to engage the U.S. on a potential deal away from these tariffs that they got. So Trump intends to meet Russian President Vladimir Putin pretty soon. We'll get more details on that and how it goes, and maybe there's this handshake deal and all of a sudden all of this is just a thing of the past. Now, Trump says he's planning quite a bit of tariffs on Russian related tariffs. So let's go through this real quick. President Trump reiterated plans to impose penalty levies on goods from countries buying Russian oil, but didn't stand by the 100% level he previously floated for so-called secondary tariffs. I never set a percentage, but we'll be doing quite a bit of that, he said. And we'll have a meeting with Russia tomorrow. We're going to see how all of that happens. Now, he's indicated that, and you see this right here, that tariffs would be set at 100, but he has much more recently declined to confirm the details. And note that China and India are major buyers of Russian raw materials and Russian oil. And nobody's forgetting about this bill right here, the bipartisan bill that was introduced earlier this year in the Senate and the House, which proposes a potential 500% tariff on imported goods from any country that buys Russian oil, gas, uranium, and any other related products. Woo! We're just getting started, y'all. Now, Trump also announced sweeping tariffs aimed at countries that continue to buy Russian energy. We just talked about that. India, which is the second largest buyer of Russian crude, has been hit with a 50% tariff on key exports to the U.S. The new levy takes effect in just 3 weeks and has already drawn sharp pretty much everybody's in India is mad about it, from Indian officials giving their point of view. It's unfair, it's unjust. We're relying on this. We're trying to keep prices good for our citizens. But on the other end, Switzerland is lobbying hard to avoid similar penalties, and talks are ongoing. Meanwhile, bipartisan bills in Congress propose an even harsher 500% tariff on imported goods. We just talked about that. And Brazil has also been hit. As of this week, a 50% tariff applies to $14.5 billion worth of Brazilian goods, including coffee beans, which make up roughly 35% of what Americans drink. Talk about drinking habits. Now, we had a Treasury auction today, and the 10-year Treasury auction this week was weak, with a bid to cover ratio of just 2.35, well below the average of 2.58. Indirect bidders, including foreign investors, only took 64% of the offering, down from the usual 71%. So we're starting to see weaker demand come in as these tariffs begin to hit. And yields came in slightly higher than expected, a sign that demand is cooling pretty much. Even the 3-year auction underperformed, and Treasury auctions are closely watched because this 10-year Treasury auction serves as a benchmark from everything from mortgage rates to corporate bonds. So a lot of borrowing is tied to these 10-year Treasury 10-year Treasury yields moves. Now, in an unprecedented move, the government is planning to auction off $100 billion in short-term T-bills, an all-time record. $100 billion. And the goal is to meet financing needs without needing to pressure the long-term interest rates, which are relatively high right now. Maybe this is their way to bring the end of the curve down and make the yield curve more sustainable. But relying too heavily on short-term debt comes with its own risks. A sudden spike in borrowing costs could leave the government exposed. This latest auction increases up from $95 billion last week is meant to offset recent tax cuts and increase federal spending. So pretty much that's where we're at, y'all. Earnings are strong, sentiment is cautiously optimistic, and retail investors are still BTD buying the dip. But underneath the surface, there's a growing sense of fragility. Government data is being questioned. Global trade is shifting. Treasury auctions are flashing early warning signs. In moments like this, everybody, the market rewards clarity, caution, and conviction. So all we can do is stay focused, stay informed, stay coming back, and stay ready. I'll see you in the next one, everybody.